All right, welcome back, everybody, to the NARPM Radio podcast. As promised, I have Eddie Ovey here, and Eddie, thank you so much for being here. Tell us a little bit about your journey and what you're trying to accomplish at this time.
Yeah, well, I'll give you the short answer, and then I'll give you the longer background as well. So I'm the founder of Grandview Peak Capital, and my goal is to buy a PM company. The now the long story. So my background is pretty varied. I'm kind of the poster child of like pivoting around in your career, trying to figure out what you want to do when you grow up. But I first started off as a chemical engineer. I'm pretty analytically based. But after a few years in manufacturing, I knew I didn't want to work in manufacturing forever. Pivoted with going to business school, then went into business consulting for a couple of years. And then the past several years, I've been in the property technology space. So I first worked at a company, and I'm based in Utah now, but I moved around quite a bit. But being in Utah, I first worked at a company called Homey. They're integrated real estate and mortgage brokerage, trying to be very tech forward and reduce the costs to the homeowner in buying a home. I left Homey and then joined Entrada. They're one of the largest property management software providers in the multifamily space, and I was there a couple of years. But then, so fast forward, I got married in 2023, and a few months after getting married, my wife and I are having all the long-term discussions of who do we want to be when we grow up, where do we want to live, all those sorts of long-term goals. And we talked about this a little bit while dating, but I was very clear, hey, I want to do something more entrepreneurial. I don't want to be necessarily in the always just trying to climb the corporate ladder. I'd like to do something more entrepreneurial. And where I ultimately landed was that I would quit my job, raise money from committed investors, and go buy a business. So fast forward, it took several months to put everything in order. But in 2024, I quit my 9 to 5. I raised my fund, which is called Grandview Peak Capital, and I am always networking around trying to find a great business to buy that I can lead and grow over the next decade. And I'm very focused on the SFR property management space because of the prior property management experience that I've had. And I would really love to make my career in the space as an owner over the next decade.
Lot to unpack here. So the first question I have is, um, I had to quit my job once upon a time as well, and a lot of people who are listening to this, they had to make that very difficult decision as well. Um, and I know we didn't talk about this in the green room, so I apologize. I'm going to throw you on the spot here. But what did you do personally to prepare to be able to, go without your income? I know your wife probably works, so like, but did you do anything to prepare for this? This a lot of times this puts a strain on a marriage. So talk about like how you came up to that revelation that you're going to do this and have the ability to do it.
Yeah, it's a great question. So first of all, my wife is a middle school teacher. She
Also,
loves
she's being in big bucks.
She brings in the big bucks. Exactly. So it's funny. She taught high school for a while, then went into the corporate world, didn't like it, and went back into teaching. But yeah, candidly, we wouldn't be able to just support our life together just based on her salary, especially as we're starting to try to have kids as well. So as I looked at various options, the option I went with in terms of raising money from committed investors, it also includes some additional money that I can use to like live for day-to-day expenses. So we're not, exactly strained. I had to take a pretty decent pay cut from my time at Entrada prior, but it's enough that we still have groceries at the end of the day. I can go to some conference. I have some additional capital to help me during this hunt for a good business to buy.
Now, how does one like so you started this fund? Um, how does one even start a fund? Like, do you just know a lot of people with a bunch of money? Did you go to school for this? Like, how do you even like start where you start a fund?
Yeah. So transparently, so my transition when I went from chemical engineering, then business consulting, et cetera. I went to school at Harvard Business School, which opened a lot of doors. Candidly, growing up, I didn't really know anyone that went to anything Ivy League. I grew up in Iowa. Kind of everyone that I knew were like blue collar workers. My dad was an engineer at a local cement plant. So this kind of career path wasn't exactly obvious to me growing up. But yeah, with going to Harvard Business School, it opened up a lot of doors. And it was through that network that I established there. I've also had friends that have gone down this similar pathway and have bought other kind of businesses. For example, a business more in the infusion healthcare space and other kinds of very kind of random businesses that you might not almost think of. But yeah, so I it was really through that network that I was able to go with this kind of a capital raise.
Yeah, so you basically learn the skills at Harvard Business School, and then basically the old adage, you are who you hang out with, and you ended up hanging out with these kind of folks that's what they do, right? Like I hang out with a bunch of property managers. We manage properties. You start hanging out with a bunch of financial guys. They get capital together and buy businesses. So very cool. All right, so now you told us why you're looking to focus on property management. Makes a lot of sense. You've had a whole career in there, and you understand it. So tell me, if some like, all right, so I'm going to take this on two angles. One angle, I want to look at it as if I'm listening to this as a property manager, and I may be like, hey, I think I want to sell. Let's talk about what you're looking for in a company for sale and how people can prepare their company for sale and maybe get the most out of it. And then I want to look at what you're looking for when purchasing a firm. So they might be very similar answers, but I'm just kind of let's look at it in two lenses. So one is I own a property management firm and I'm looking to sell the firm. What should I be doing as a way to I could get the most out of my out of all my efforts?
Yeah. So yeah, lots to unpack there, but we'll start with the question of yeah, if you're a PM owner, what should you do in order to prepare your company for sale, right?
Yep.
I'll say generally speaking, as a PM owner, it's I mean, you want to do two things. You want to grow the top line and you want to grow the bottom line. You want to increase your unit count, but also you shouldn't just grow your unit count at all costs. You should be thinking about the homeowners that you're bringing on and make sure that you can actually generate a decent profit at the end of the day. That being said, when you're starting to prepare, maybe starting to think about selling your company, not all companies or not all buyers are going to look at your company the same way. So for a buyer like me, transparently, I'm looking for a company that probably has at least around $500,000 of cash flow. And, it depends on market dynamics and things like that, but generally looking for a PM company with around a thousand doors or more. Obviously it could be maybe a little bit down, a little bit up, depending on the geography that you're in. But that's kind of where I can get the numbers to pencil on my end. And for me, as a potential buyer, I don't own an existing PM company. I don't bring my own existing team of accountants and property managers and don't already have a giant VA team overseas that I'm just immediately going to plug in. And so for me, I value a company based on its cash flow. And so different multiples depending on the size and the growth and the other dynamics of your company, right? But other buyers, they might value your company more based only on the top line because they're going to be very, very interested in just buying the existing homeowner contracts that you have. They have their existing team. They can value your company in a different manner. So happy to discuss more of kind of the differences, and I'll explain maybe my value prop as a potential buyer, but maybe I'll stop there.
Yeah, so if I hear you correctly, somebody who's looking at top line looks at top line because they already have maybe some infrastructure and they can absorb some of those people and they can maybe cut a lot of cost. So the profit margin isn't really as uh, it's getting the doors and getting the revenue is more important than maybe getting the profit. Where you are going to basically, in this case, in this scenario, you're going to basically bring in everybody from the company and just basically run the company almost as is and making tweaks. Is that sound about right? That's why you're looking at more of a uh, profit play than a top line revenue play.
That's exactly right. So, and this kind of, I'll illustrate kind of the value prop that I bring as a potential buyer, right? So, there are a lot of aggregators in the space, a lot of really well managed companies that continue to either have like a regional or a national footprint now in property management, right? And so, um, I'm going to overgeneralize a little bit, but like in many cases, if you're going to sell to a very well established company, like one of the more national players, they might have a model where if you were to sell to them, they want you to continue operating your company for the next 2, 3, 4 years. They maybe don't want you to exit right away. That may or may not work for you as a potential seller. Maybe you're like, man, I really want to retire, and I don't want to be still in the business for another 3 years. Other buyers might also say, hey, we have our existing team. We're going to do things our way. When we buy your company, maybe they'll say this upfront or not, but like they might cut like half your staff because they have their own team that they can immediately plug in all your homeowners and work with them. So, and that may not also be something that you're looking for as a PM owner, saying, oh man, but I've got such a great staff. I've worked so hard in building this team over the last 5, 10 years, whatever it might have been. So my value prop really as a potential buyer is that I'm looking for a company that I can almost kind of transition with the existing owner or owners, right? Like not looking, I don't have my existing team that I'm replace to existing. I also don't hire any sort of like long transition plan. I offer a lot more flexibility if you wanted to be out within just a month or two, or wanted to transition over a year, or even if you wanted to look at some sort of more partnership agreement where I come on, but the previous owners continue in some sort of like C-suite capacity with the company. So that's kind of my value as a buyer. But because I don't in my own team in order to continue to grow a sustainable business and therefore base the company based on the cash flow it's generating, not on some like revenue multiple.
Are there any other factors like you touched on a number of units. What about like the different types of units? Is there any um, is there any benefit of having like single family plus multifamily or all single family? And then the second part of that question is, what about multiple markets? Is it more beneficial to be in multiple markets? Maybe I'm in 3 cities in one state or something like that.
Those are great questions, and like what I'm going to give the consultant answer that it depends, right? But in a couple examples, right? Like if you're in multiple markets, one, that can be a great thing if you are well run in all those markets. If you're in multiple markets, but you're still very much tinkering in those markets, and you have 4%, 5% monthly churn or something really atrocious like that, that's probably you probably stretch yourself too thin. So I'd say, generally speaking, for me as a buyer, I'm looking for a company that is pretty well run, that has churn under control, has things pretty much dialed in, so that we can continue to grow in the long term, and maybe enter additional markets over time. But is a little bit more dialed in. So that was the kind of the that part. In terms of like what kind of units to work with, at the end of the day, again, it goes back to being a well-run company. Multifamily and single-family property management are very, very different. Different margins, different response levels in terms of like maintenance and things like
Yeah.
that. And so, I generally would say stick in your lane. Do what you know well. Not to say that you can't do both eventually, but you almost need like different teams and different capabilities for each of those two areas. And sometimes there is a little bit of a blending, right? Because like there are maybe smaller multifamily units that can kind of blend in between SFR and multifamily. But generally speaking, I'd say, yeah, pick what you do well and just crush it.
Talk a little bit about contracts versus asset. Whereas, like when I sold my firm, we sold the contracts. We didn't sell the company, the assets. Um, do most people buy just the contracts? Are they buying the assets? And what are you looking for?
Yeah, I mean, so I also follow, for example, Peter Lohman, Todd Ortscheid. They do a really good job of kind of analyzing current dynamics. And if you follow the Peter Lohman with the recent M&A study he's done, and Todd, gave like a short report on this, which is free and accessible. I highly recommend going and reading that well. But from that analysis, about 2/3 of the companies in that study were sold to aggregators or existing companies in the space. Um, and so I would assume in those cases, oftentimes, and I can't, without knowing specific deals, I'm just kind of speculating a little bit. But for smaller companies, call it 100, 200 doors, it's more likely that would be just selling the contracts because these aggregators are like, hey, we're already in this market. We're just going to plug your homeowners right into our existing operations. They don't need your current staff, and so therefore they're not going to do an asset sale. They're just going to buy the contracts. If it's a larger company, then hopefully there's, and even if you sold to an aggregator, maybe they're not yet into that geography, and so they're like, hey, we do want to do actually an asset sale, where we're going to buy everything, your existing team, operations, contracts, etc., because maybe they're not in that market yet. But without knowing specific deals, I'm just giving some patterns of what I've seen.
Yeah, I know. Again, I'm just using my experience. When I sold my firm, they were adamant that they did not want an asset sale because of the risk, right? Because I don't know if this is national, but in Texas, you have like I think 4 years to file a claim, um, different types of claims, and it actually worked in their favor because 2 years after I sold, I got hit with a claim, some kind of lawsuit. So and of course. It was before the sale, so I know a lot of times they don't want to buy the asset, but in your case, you might want to buy the whole asset because you don't have anything in play yet, right? So you'd actually have the company structure, the website, all that good stuff. Yep. Now,
Yeah, and without going into too much, just to add up one follow-up point, because when you do buy a company, it's in its entirety and not just like the contracts. There are usually two different kind of purchase routes. You can either do an asset sale or a stock sale. And generally speaking, like the asset sale is more buyer friendly, because it allows you to buy the company without, if for example there was some litigation that someone wanted to bring against the prior company, it kind of wipes the slate clean for the new buyer. So buyers, generally speaking, want to do an asset purchase of a business versus a stock sale. It can have some additional tax benefits to the seller, and that's why they would probably prefer that route. There's also some hybrid options in between, but without going into all the details, those are a couple different kind of actual purchase options when selling a company.
spoken like a true Harvard business law degree, business graduate. All right, so let's talk about now, okay, so we talked a little bit about like how big your property management should be. We talked a little bit about a number of units being niched down, really reducing churn, focusing on growth, but also profit. Now let's talk about the structure of the deal. So a lot of companies might buy top line, they might buy an EBITDA of profit or something like that. But now let's talk about because again, I can only go my experience. In my experience, the price was non-negotiable, but the terms were. So talk about what are some of the terms when purchasing or when you're selling your PM firm.
Sure. So first of all, and again, going to valuation, some companies value you a rental. Some, like myself, value a company more on an EBITDA multiple. Once we get to evaluation, though, there is some structure elements that come into play as well. So usually you want to get as much cash up front when you're selling your business. You don't want a whole lot of structure to it. If you have a strong property management company, uh, it should be a mostly cash offer. Oftentimes you see some additional structure you'll see is a seller note. So I
You
typically
just
try
cut out there
to,
a quick
and
second.
this is because, oh, so
So
can you
you
hear me
cut out
now?
there real quick. Can you say that again?
So yeah, in terms of the structure, number one, as a seller, you'd want to seek as much cash up front when you're selling the business. But then some of the other additional structure elements. Number two, there's what's called a seller note. That's usually see maybe like a 10 to 15% overall amount of the purchase price as a seller note. And that's based on basically you as the seller will, it's almost like a loan to the buyer that you'll have an interest rate, you'll gain additional interest over time, but it also bridges the gap a little bit of a, hey, me as a buyer, I want you, the seller, to still have some skin on the game and not just be like burning bridges on your way out. So it's a little bit of a mechanism to try to bridge that gap and make sure that there is alignment in properly transitioning the business. A lot of another thing that's in the structure as well. Oftentimes you'll see the ability to roll over equity, meaning that let's say you sold your company for $10 million, and the buyer says, hey, you can roll over up to 20% into the new deal. What that would mean is you would take like $2 million of the 10 million just sold and have that 2 million invested in the new structure of the business. Me as a buyer, I allow up to 20% rollover equity into the company that I would be buying. So that's one example. Other buyers may offer more or less depending on their specific dynamics. And then the last thing you might often see as well is some sort of contingent or earnout. This was oftentimes based on homeowner retention. So they'll put some sort of incentive on and say, hey, if we a year from now have retention of 90% of the homes that we were under contract with when we bought the business, then you'll earn this additional amount of money. So that's another lever that you'll often see in these kind of transactions as well.
Yeah, that's basically churn rate, right? When you talk about that, like, so churn rate. Yeah, again, I
Yeah.
just go back to my experience. We got I think it was a 60-20-20, so we had like a 2-year payout. Um, and then I think we had a max of 20% could get removed based on churn that first year. And then we were able to take 20% in the sale as stock if we chose to. So yeah, you hit on basically all those points. Um,
Yeah. One thing I'll add is, like, if you as a seller are like, you know what, just pay me cash up front, what that usually is going to mean is it'll probably be a lower valuation.
Mhm.
People can usually stretch the valuation a bit higher if a seller is open to some of these more contingent or seller note kind of options.
Which makes sense, right? So, hey, I'll give you more money up front, but because I'm going to have some churn, we all know that I'm going to reduce the price by X%. But then as the seller, you're kind of free, you're shackled. Like I was worried for almost 2 years about churn and are they, is the company going to be around in 2 years to actually pay me the last percentage. I think also in the contract, they can actually give you back doors they don't want, which when you sell, you don't want to go back into management. Like, unfortunately, I've seen this happen where somebody I knew sold a bunch of properties, company took them, and then about 2-3 years later, and he had like a 6-year payout, which just crazy to me that you would go that long. I think 3 is kind of the max. I was able to work a 2-year, but what happened was in 3 years, they decided they're going to keep all the good properties in a concentrated area and then give him back some of the properties and then reduce the payout because they gave him back the properties. And it ended up working out well for him. At the first, he hated it because he didn't want to get back into it. But now he's actually growing the business again. He could probably resell it again, probably to the same company.
Yeah.
So really interesting. I think when you're also, let's talk a little bit about the mindset because when you're buying somebody's PM firm, most likely they put blood, sweat, tears into it, and it's very emotional for them and not emotional for you. It's numbers. How do you navigate those waters?
Yeah, I mean, so first of all, at the end of the day, I do have to get the numbers to pencil. I have investors that are backing me, et cetera, right? But I am looking for a company that has a really great team, great culture. I'm not looking at coming in and really changing that all too much. Maybe some other buyers would, right? But that's if anything, I'm looking for a seller that has a pretty strong property management company, and doesn't want to tear it down in any big shape or form. They want to find someone that is going to. I don't like to use the term too much, but carry on their legacy is kind of a overused term that people sometimes say. But that's kind of what I'm looking at doing is a company that has a really good team. It's been built on blood, sweat, and tears, and my goal as an operator isn't really to change much probably for the first 3 months or maybe even first 6 months. Ideally, I'd like to learn as much as I can from the existing team in place. And then, I do have a decent amount of knowledge in the space and other just general business training. So I will make tweaks over time, which if the previous owner did want to stay on in the business, that can often be hard to maybe hard to tolerate, right? Because it was your baby and you built it in very intentional ways, and it's hard to see it change. But at least in the short term, I really would want to just grow with the existing team and then make some additional tweaks in the long term.
And I would say from the seller's perspective, I think you need to know, maybe you've owned this PM firm for 10, 15, 20 years. You really need to know what you're going to do next. Because what I've seen, and this happened to me personally, and I've seen this with other folks, they sell the business and now they really didn't prepare for the next chapter in their life, and they get depressed. They got a bunch of money in the bank, but now they have no purpose. And so if you're listening to this and you are thinking about selling, I would say, like, even if you're going to, ride out in the sunset, that's great, but understand that's what you want to do and that's what you're going to do. Because, for me personally, I had more money in my bank account. Took a job because I didn't know what to do next. I was getting paid very, very well, and I was really unhappy. And I was actually a terrible employee for the company that purchased me. And 18 months later, we decided to part ways. And it was probably 6 months too late, to be quite honest with you, for both of us. And so I would just caution, just a cautionary tale, like, because if somebody purchases you, and let's say it's Eddie, yeah, okay, maybe you stay on for 90 days as a transition, but at the end of the day, you don't own that firm anymore, and somebody else does, and they are going to make decisions that most likely you're not going to agree with from time to time, and that's going to be really hard because the buck used to stop with you, and now you have to, basically, you're working for somebody else, and so you got to be mindful of that. Yep.
Yeah, that's exactly right.
All right, Eddie. Is there anything else that we need to touch upon on purchasing or selling? Oh, you know what? Let's do this. Super high level. Kind of give us like the step by step. So let's say somebody is interested, right? What's the first step? Is it an LOI? Are you doing due diligence? Kind of just talk about high level what those steps are for that go through the purchase.
Sure. Yeah, I'll illustrate my process in a little bit more detail, because my process is probably a little bit more personal and hands-on, transparently than maybe some other buyers that they see the contracts and they want to close really quickly. So like I illustrated earlier, I'm looking nationwide for a business to buy. And my wife and I are both on board that we're going to be moving to wherever the location of the business is. I want to be very much a hands-on operator. So if your business is if I were to buy a business in North Carolina, I'm moving from Utah to North Carolina to operate that business hands-on. But how it typically works, and I have active conversations with various buyers today or sellers today. But usually it starts off with just an intro call, start to get to know one another, because I am looking for a good, not only a good company, but a good mutual cultural fit that I can come in as an operator. So starts off with just an intro phone call to introduce myself. They talk about their company, their team, start to talk about, what would an ideal transition look like to them. From there, I'll send over an NDA so we can talk in more confidential terms, and have them send over financials, preferably from the last 3 years, to so that I can get a better understanding of that. I also want to see a little bit more and get more information on the number of units, and the overall churn that they've experienced. From there, I'd love to try to meet people in person. I'm not one to just make a deal without ever kind of seeing face to face. Maybe I'm a little bit more old school in that fact, but I'd fly out to meet you, make sure that we're seeing eye to eye on things, and then ultimately send over a letter of intent, or LOI, to buy your business. The LOI is it puts forth kind of the standard agreement of how I'm going to buy your business. This is the valuation. Here's what we're contemplating for a transition plan. Here's the due diligence items that I'll be doing during the process. And there might be a little bit of back and forth on some of the terms, but ultimately, if the seller then signs the LOI, then we're off to the races. So it takes somewhere for me to buy the business between 90 to 120 days to close on the business. Some of the key steps that I do is I work with my accounting provider to do what's called a quality of earnings, which is basically just double checking to make sure all the math pencils, that you're making as much money as you say you are, that your books are saying they are. And then some other, from there we do other diligence items to create what's called the purchase agreement. That is the binding document that when we sign the purchase agreement, then we set the close date and work with that overall close and transition.
And part of your due diligence, you're doing the earnings deal. Are you also tying up like the security deposits and like all that other, like, are you looking at that stuff as well, making sure all that stuff ties together?
Correct. Yeah. So we put together, that sort of transition plan for all the different accounts, and the trust accounting and all that sort of stuff. Yep.
Nice. All right, Eddie, I could talk to you all day about this stuff, but we're going to hit a quick commercial break and then we're going to put you in the lightning round. We'll be right back, everybody. All right, we're back. We're going to put Eddie Ovey in the lightning round. Eddie, are you ready?
Let's do it.
All right. What is one piece of advice you'd give someone just starting out in business?
Oh, it's a good question. Probably my advice would
Go to
be,
Harvard and meet some bigwig friends and raise a bunch of money?
I mean, that's one pathway. I would generally say, like, be intentional with what you want out of your career and your life. I think there's too many people that say, you know what, I want to work 30, 40 hours a week and I want to make millions of dollars. And it's like, well, those two goals don't quite align. Something's probably going to have to give. And so I think more than anything, the advice I'd give is be intentional. Do you want really good work-life balance? Do you want to just make a ton of money? Like, what are the goals you have, and make sure that you understand the trade-offs implied in the goals that you're trying to set.
If you could have dinner with anyone alive, who would it be?
And sorry, you cut up a little bit. Was it?
Yeah.
Go ahead again.
If you could have dinner with anyone alive, who would it be?
Ooh, that's a good question as well. I'd probably say, so someone that's been through a giant, transition in terms of like, basically taking a business from basically zero to continuing to run it today. I mean, love him or hate him, I would love to sit down and chat with Mark Zuckerberg. He's a rarity of someone that has taken a business literally from coding in his dorm to now one of the biggest companies in the world. And it's a really hard skill set to, go from, they call 0 to 1, like basically go from nothing to actually have a business, but then take it from a okay business to 50 to 100 million in revenue and then take it to the next step after that. Usually you see a lot of leadership transitions in getting to that stage, but he's been able to navigate that probably better than almost anyone I've seen. So I'd love to sit down and chat with him.
What condiment do you put on your hamburger? Is it, hold on, we'll pause there. Can you hear me now?
Yeah, you're breaking up quite a bit now.
All right, how about now? Can you hear me?
Yeah, it shows like red bars under your name, so I can hear you better now, but it has been pretty choppy the last minute.
Yeah. All right. Starting it. Okay. All right. What condiment do you put on your hamburger? Ketchup, mustard, mayo, or none?
Generally speaking, I like the more condiments and toppings, the better. So I usually put ketchup and mustard. I won't say no to mayonnaise, but if I'm making my own burger, generally I skip the mayonnaise. But burgers are one of my favorite foods, and I just love all the toppings on it.
What is a book or a podcast that has impacted your business or life that you would recommend?
Yeah, so I mean, while I was at business school, the second year there's a class offered by uh, they're kind of colloquially known as Rick and Royce, but they teach a class on entrepreneurship and buying business. They call the class small firms, or I forget the exact name of it. But they launched a podcast in the last couple of years. Not only do they have a book that talks about buying businesses, but they've also launched a podcast called Think Big, Buy Small. And yeah, I'd say that class and those professors were very inspirational, kind of planted the seed. It took several years after business school for me to decide to take the entrepreneurial leap. But yeah, very, very inspirational. And I continue to try to follow what they're saying and doing today.
All right. Last one. Do you prefer dogs or cats?
Sorry, you broke up there again.
All right. Last one. Do you prefer dogs or cats?
I prefer dogs.
Dog guy. All right. We'll get you off the
And
hot
best
seat.
friend.
All right. We're going to get you off the hot seat here. If anyone's listening and they want to reach out to you, what's the best way to contact you?
Yeah, so the best email to reach me at is eddie@gvpeakpm.com. But feel free as well. My number is always available for a text or a short call. Number is 801-641-1609.
Give us that number one more time.
Yep, my number is 801-641-1609.
And it's at Eddie at gvcapitalpm.com.
Yeah, the best email to reach me at is eddie@gvpeak, P-E-A-K, pm.com.
All right. And if you're listening to this and you want to join NARPM, you're not a NARPM member, shame on you. Go to NARPM, NARPM.org, or give them a call at 800-782-3452. And if you are in the market for looking at remote team members, maybe you need a maintenance coordinator, social media, leasing them in, marketing person, go to vpmsolutions.com. We are now close to 50 free training videos on the platform where people can take them, test out, get a certification, a VPM certification in property management. Eddie, thanks so much for being here today. We'll see you, everybody.